Okay, good afternoon, everyone. Welcome to the very first event here in the Danish Accounting Network. And of course, a special welcome to our speaker for today, Dean Sorensen, who's with us all the way from the US West Coast, where it's now approximately 7 a.m. in the morning. So that's a fresh start for you, Dean. Thank you for being here.
Happy to be here.
Good, thanks. So the agenda for today's webinar is as follows. First, I'd like to take just a few minutes to give a brief introduction to this initiative called the Danish Accounting Network. And then the main attraction, of course, is the presentation by Dean, Fixing Flaws in Integrated Planning, followed by a Q&A for the last 15 minutes or so. So you have the opportunity to ask all the questions you have, and please do so by asking them in the chat. Then I will do what I can to keep an eye on that and try to facilitate the discussion towards the end. Please be aware that this presentation is being recorded just for information, and we will, of course, share it with all of you who have signed up and also all the members of the Danish Accounting Network after the webinar today. Good. Oh, sorry. So the Danish Accounting Network is quite new. It's in its infancy, you could say. It's founded in the summer 2022, a couple of months ago, as a cooperation between Aarhus University and Copenhagen Business School. My dear colleague, Thomas Bo Christensen of Aarhus, and myself decided to initiate this because we felt there was a need for some national association or network where like-minded business finance people could share their insights, knowledge, and network across the country about and around all these interesting challenges that are facing business finance professionals today. As we like to say, we are powered by academics but focused on practice. We believe that this network should be in the interface between academia and the practical business finance society, because we feel that there is an urgent need for academics to try to understand better what kind of problems practitioners are struggling with in order to continue being relevant to the business society. And we hope that we also can add some academic rigor to research some of the issues that you're facing out there. So essentially, we have three main purposes with the network here. Knowledge sharing and research, of course. We would very much like to address some of these questions that I mentioned together with you and discuss them, and perhaps do some good research on what finance functions are facing currently. Today's event is a good example of a knowledge sharing event. We hope we can plan and execute much more similar events in the future. Second, of course, networking and matchmaking. We hope very soon also to be able to have offline events in real life, so to speak, where participants in the network can come and join and meet peers from who are struggling with some of the same challenges. But it's also a platform where you can reach out if you're looking for or hiring business finance professionals or student assistants, because we also have a quite substantial amount of students in the network already. And then, of course, we also have an ambition to try and improve management accounting teaching at all levels: bachelor, master's level, executive level, and PhD level, by bringing in hopefully some good insights on some of the latest challenging facing our discipline. So I hope you'll join us if you didn't already do so. We have a group on LinkedIn called Danish Accounting Network. Please join that group, and you will also hear more about future events and have access to some of the knowledge that is shared there on a regular basis. So today's speaker, Dean Sorensen, who's going to talk about integrated business planning, is a partner and founder of IBP Collaborative. Dean is a very seasoned, very experienced management consultant, spending more than 20 years in management consulting in various very well-known consultancies. Dean has worked with more than 100 manufacturers on the issues or the topic of integrated business planning that he's going to talk about today, and work with some very large global manufacturing companies. So we're very excited to have you with us, Dean, today, and look very much forward to a hopefully insightful presentation. So the floor is yours.
Okay, thank you. Hopefully you can see my screen now. Yeah, okay, good. So first off, it's good to be with you. And as well, one thing, as you can probably tell by the spelling of my last name, is that my family's from Copenhagen. In fact, I actually do have family in Copenhagen. And you know, one of the things I didn't have to do today was tell people how to spell my last name, which is usually something I have to do. But today is, as Martin said, the topic today will be on integrated business planning or integrated planning and performance management. And while a lot of the examples are relate to manufacturing, I'll try to relate those to some of the other industries. But I think that, you know, the adoption is probably heavier in manufacturing. And one of the things that we want to do is talk about some of the experiences that companies are having with it. So the focus of integrated planning in terms of what we want to get across today is more about how it enables companies to improve their ability to manage profitability and cost, but a whole bunch of other things, one of which is the ability to manage complexity. But the challenges that they have relate to a number of processes in finance and operations. And the questions that we'll be asking or answering today is, you know, what is fully integrated? What capabilities comprise it? You know, what do you mean by data-driven processes? And you can see all the other questions we'll ask. And answering these questions, I think, is highly relevant to any finance function that's undergoing any sort of transformation or seeking to become more effective business partner, which is probably the vast majority of most finance functions these days. And one of the things I think that integration does is that it enables company to execute the strategies or achieve the objectives they're trying to achieve. One of which is what I call dynamic cost and profit optimization. So how do you get your cost structures in line with the strategies you're pursuing? But you can see all the other ones on the screen here, which I'll address during the presentation. So in terms of an agenda, what I'd like to do is first just take a step back and talk about the current state, just get a sense for what's currently happening out there. Then I'd like to talk to you about a case study that I worked on with a client that really kind of illustrates the problem. And it's a fairly straightforward problem. And it is a manufacturing case study, but it's actually the part of the manufacturer is not specifically, doesn't necessarily have to be considered a manufacturing example. So based on that, then we'll talk about like what capabilities comprise like a fully integrated planning and performance management solution or process, and what's missing. Then what I'd like to do is introduce a maturity model that really kind of frames how these capabilities fit in terms of achieving full integration and the value associated with those different levels of maturity. Then I'd like to talk about what an integrated process looks like. You know, what are the steps? You know, how does everything fit? Then I'd like to talk about the role of finance in sort of driving this and the capabilities that they need to have going forward. Then I'd like to introduce you to like a CFO that I've worked with, and this guy's a real forward-thinking guy. I think you'll find his insights very interesting. I think that he and I have some kind of similar views, but I'll let him kind of share his thoughts on this, and I think you'll find it very interesting. And then we'll kind of wrap up and have some time for some discussion. So let's get into the current state. So the first thing I want to do when I talk about the current state is just really talk about what is it that we're really talking about here, because if you look out in the market, there's so many different integration terms. And I'm going to focus on a couple here. You can see them down here, and there's a summary of what these things mean at the bottom. But more specific, I'll focus on integrated business planning, and then one you'll hear a lot of is integrated financial planning or integrated financial planning and analysis. And I don't know if any of you saw this, but there's been a number of discussion topics out there, like, which one's better, and, is one more broader than the other. And my answer to that is, the reality is that I don't think either of those terms really represent what I mean by a fully integrated process. There's really some things missing, I think, in the way, we're really thinking about integrated business planning. So one of the things I've observed, if you look at kind of small manufacturers and simple manufacturers, the reality is that there's a lot of really good stories about things that are happening there and why it's a good thing. So I think there's the benefits, I think, are not overstated in kind of simpler manufacturers. The problem is that when you get bigger, what ends up happening is that a lot of companies are not getting the benefits over as they get larger and more complex. So, and they're also experiencing some value erosion. And if you see some of the problems that companies are having, so from a financial planning perspective, the bigger the company gets, they may have done FP&A, they've done IBP, they've done balanced scorecard, blah blah blah. They're still having trouble doing scenario planning from a financial perspective. They still have profit and cost management issues. You can see the other ones, but the same thing's happening on the operations side. Scenario planning is difficult. They're establishing a profit-based integrated planning process is a big topic, and driving decision making and engaging executives becomes problematic. And one point I'll make here is that when we hear a lot of companies talking about end-to-end integrated scenario planning, that to me is a bit of a myth these days. The bigger you get, the less likely it is that that's happening, and I'll explain why I say that in a little bit. So if you look at what's happening with sales and operations planning, and if you look at how things work over time, let's say that if you see revenue going up, gross profit going up, inventory turnover going up, and all these things are good. But what's also happening in a lot of cases is that companies find that net profit is not necessarily going up, and free cash flow is not necessarily going up. And one reason for that is that overhead costs are going up, and not only are overhead costs going up, but there's a lot more variability because you usually have different products and customers, that kind of thing. And what's more, with digital transformation, that variability is going up even faster. So one of the things that we've done, I don't know if any of you know what activity-based costing is, but activity-based costing is essentially, if you could take a stopwatch and then just record what every person is doing in the company in terms of which product and customers they're working on. Typically, you'd end up finding that what's in your accounting system is different than what's really happening. And you find these results over and over again. It's pretty consistent as to why it is that companies' accounting systems are not measuring profitability correctly. Much of it has to do with misallocation of overhead. And not only does that affect the profitability of products and customers, it also affects the profitability of your business segments, especially if your business segments are crossing multiple legal entities. You'll find that there are major distortions in terms of how profitable certain business segments are. Now, the reality is that these distortions, if you look at FP&A and integrated planning tools, they've not fixed these problems. And really what we ought to be looking for are tools that help us understand how profitability behaves. So we really shouldn't have these distortions. If you've got the right planning model, you should never have these distortions in the first place. And because of these distortions, what ends up happening is that people end up making the wrong decisions, or they're not centered on value. And a classic example is in your new product development process. So let's say that you've got a brand new customer that wants a new product, and their target cost is a little higher. The existing products that you have don't meet the target cost. So you might look at, let's say if we look at the new product and an existing product, that the new product would actually have a lower cost. So we engineer it to have a lower cost than the existing one. But then when you add in kind of the traditional overhead costs, now you're kind of meeting the target cost. But then when you factor it in from a activity-based costing perspective, you see that it's not meeting the cost. What's more, if you look at the impact on cash flow, there's often a really big difference. And that difference between the decision that you should have made and what the decisions that are actually made is contributing to what I call the cost of complexity. And ultimately, when you run into situations where you're making these decisions incorrectly, it's really because you can't plan and manage outcomes well, right? Because you're not really looking at everything. And this is what I mean by this. It's not that you don't have good people or anything like that. It's just that your business just becomes too complex that you end up making wrong decisions about these things. And one of the reasons why, one of the things a lot of companies experience is that after you do activity-based costing, they fix some things, they actually can't sustain cost reductions. And one of the reasons for this is that they can't prevent them in the first place. And if you look at, I did a summary of a bunch of different research studies, but this one here summarizes these here, but there's a whole bunch of other ones here. I mean, and ultimately, if you look at what's common to all these different research studies is that they really stem from an inability to plan, manage, and govern outcomes from a strategic, financial, and operational perspective. And again, this contributes to the cost of complexity, which is about 3 to 5% of sales in this research study, but there's a number of ones that measure it differently. So the reality is that we've got these management systems and processes that we're using that aren't preventing this. Now, one of the reasons why I understand that the value of this is that I used to work for a prescriptive analytics software company, and we would routinely find value in about 2 to 10% of sales across these different types of projects, if you will. But in 2 cases, we actually saved companies more than $1 billion. And so these are highly sophisticated models. And the problem that it's solving is that most companies still have very fragmented and siloed planning and performance management processes. And this prescriptive analytics tool that we had isolated those things. Now, having said that, the company has since gone out of business, so I'm not trying to promote this software product. But one of the things I'm going to introduce when we get in a little later on is this graphic here that talks about what this kind of model looks like and why it's relevant to finance. But ultimately, one of the things that we're doing here is fixing this problem, which is connecting outcomes and targets to activities and resources. And this is ultimately the problem that companies are having, is kind of managing these intersection points. And more specifically, understanding the trade-offs associated with those intersection points. That's the problem that a lot of companies have. And this whole idea of managing trade-offs, what you'll find, you'll hear me talk about this a lot through the presentation, but it's managing these trade-offs, in this case, between customer expectations and shareholder expectations, or between operational and financial outcomes, or another way of talking about it is inputs and outputs. It's just a very simple problem that a lot of companies have. And one of the things that really is problematic for a lot of companies, if you look at, ultimately the source of a lot of this is that we still don't have solutions that enable us to effectively manage overheads. I haven't seen a lot of the FP&A tools really aren't doing anything, I think, of significance here, nor are the financial planning tools. So these things are kind of falling between the cracks. Now, from an FP&A perspective, as it relates to manufacturing, one of the biggest problems that FP&A tools have is that most are kind of general purpose and are not manufacturing specific. So the reality is that they're not really supporting what I would call effective planning tools that are relevant to the manufacturing sector. And I'll give you a couple of examples later on, but this to me is one of the biggest problems, just this gap in the marketplace where there's a hole in the capabilities. So let me quickly just talk about a case study that illustrates some of this. So I was working for a company who was a publisher of school books, and one of the things that ended up happening is that it had a pretty significant deterioration in performance, high inventory, stockouts, back orders, and all that stuff. So, our objective was to fix the problem, evaluate their sales and operations planning process and see how what was contributing to it, and evaluate a potential ERP investment was sort of a side objective. And so what ended up happening is that we recovered control, but it still wiped out a big portion of their profits. And one of the things we ended up saying is that, look, you've got some flawed planning processes, but the reality is that, a big portion of your supply chain function is terribly understaffed. And if you don't fix it, you're going to have some problems in the future. Of course, when we talked to the CFO, he really didn't believe it. And he said, well, you got to tell me how you got to this conclusion, because I just don't see this. So let me just talk to you about how it was that we came to this conclusion. So first thing, this is, by the way, a simple version of what ended up of the company and the analysis that we did. So if you look at the different types of books that they have and what they were doing, they were selling school books to high schools and universities. So if you look at the different types of books that they had, so there were simple books which categorized here, and then more complicated ones over here. What was happening in the book industry is that X number of years ago in the US, you sell a history book to every school, every high school. It would be the same one. Of course, then what ended up happening was that, well, California wants their own chapter for history, and New York wants one. So the reality is that a book's not a book anymore. And then, of course, now you've got digital entering, and that now you've got teacher's aids, you've got online stuff. So it just gets far more complicated. And the reality is that their ERP systems weren't set up to handle this. So if you look at the mix of their books, and let's say this is the number of titles, the way that they ended up coming up with the staffing was, look, if we're going to manage these books, these ones are pretty steady, pretty simple books, and we only need to review those things 5 times a year. But these real complicated ones, we need to be reviewing once a week if we're really kind of deliver the type of service that we want. So given the hours per review, this turns into this many hours, and that turns into staffing of 24. And these metrics are the types of things that ended up going into the budgeting process, and they really didn't change that much. So so these are kind of the stats as to how they ended up incorporating these in their financial planning process. Now, of course, what ended up happening is you see the mix up here. The mix up here was actually changing quite a bit. So if you do the math, they're basically understaffed by a factor of almost by 50%. But what was happening was that they were maintaining their staffing levels by reducing the number of reviews. And that's the thing that killed them. So because they weren't reviewing it sufficiently, they were missing things. And then if you look at their strategy in terms of how their mix of books was going to change over the next number of years, you do the math, and it gets pretty ugly pretty fast. And when we showed this to the CFO, he said, "Oh my God, I had no idea this was happening." So what ended up happening was that the next day they basically started working on an ERP system. But one of the things that the person who is leading the supply chain function said, "Look, I've been telling you this for 5 years. You've just chosen not to listen to me. You've been using these historical trends and all that. This is really kind of symptomatic of a lot of problems with the financial planning process." And I've done similar, I've probably done like a dozen of these things where I've kind of come up with similar conclusions. But the reality is that, you know, if you're not, if your planning process is not resource-based, you're probably going to miss some of this stuff. And this problem gets even worse when you start looking at how digital transformation is going to affect this, because resource consumption changes significantly. So the big aha about this. So one of the things that ended up happening was that, you know, I did all this stuff on spreadsheets, but what ended up happening was that the person who was running this function ended up using those spreadsheets, you know, that articulated these the activities they needed in the function, and it was a resource-based approach, but really articulated these trade-offs between service levels and resource requirements. So what ended up happening was that the whole conversation she would end up having with the CFO totally changed. So the conversation become, you tell me what volumes you're going to throw at me, you tell me what service levels you want, and I'll tell you how many people we need. So that whole process, she used to spend 2 to 3 elapsed months on the budget process. We got it down to 2 to 3 days. And what's more, this Excel-based model that we put together, she and her assistant would end up spending less than a day a month on this. And one of the reasons why it was so effective, it was her model. And this whole idea of distributed model ownership really kind of drove a lot of this. And really what this was we incorporated things like zero-based budgeting, driver-based planning. It's just a more mature form of it. And it really kind of drove those kind of changes. But one of the things it did was these sorts of things I think are really relevant in making rolling forecasts more effective, because one of the things they focused on was not how much you were spending, but what your productivity rates was. Like, what are you spending per book versus the target? And it was really sensitive to volume and mix changes. So whatever the volumes were, she got the resources that they needed. And it was very specific about how those conversations were had. And essentially, one of the things that I'm showing here is how do you extend integrated planning and sales and operations planning beyond manufacturing, because this is the same sort of thing that's going on in integrated business planning processes and what makes it so effective. But the challenge that IBP processes are having is, how do you make this more profit-based? And this whole idea of doing this at an activity level is really kind of the underlying thing that drives it. Now, just as a commentary as well, one of the things that we were able to do is show how in the long term that they were going to be terribly understaffed. And really, this sort of information should be available at people's fingertips. And, the idea that there might have been 100 people short, that should have been something that just kind of rolls off a rolling forecast process, but it doesn't in most companies. So the major thing here that ended up happening is that there was just the key improvement was we integrated target setting and resource allocation. And the reality is, the manager viewed the whole process as being fair because they had this dialogue between finance and ops. And one of the things that this did is that it eliminated unwritten rules. So if you look at these things here, whenever I put this up, and if I'm in a live audience, people start laughing. But if you look at the behaviors people behave, like always under promise and over deliver, never submit your real budget the first time, these are symptoms of processes where your target setting and resource allocation processes are not working well. And much more, people don't believe they're fair, so they feel like they have to play games. So what this did was that it solved the problem for the manager. And I think that if you look at this whole idea of managing expectations, it is a huge problem for most companies. And if you look at this research study, there's a couple of them here, but the reality is that most companies do a really bad job at managing customer expectations. And if you cannot do it internally, the likelihood of you doing it externally are really pretty bad. So if you go back to this chart I showed you, this expectation management problem, inability to, articulate how many people you need to execute a strategy, that's a big portion of the problem that companies are facing. It's how do you figure out, given what we're trying to achieve, what resources we need? And that's the problem that companies are having. Now, I'm not going to explain this slide. Basically, what this slide represents is if I were going to take this entire process and stick it into a system, what would it look like? And I'm going to come back to this a little later on when we talk about process. So this slide represents, the output of what we just talked about inside a formal process. So let me quickly just talk about what capabilities that companies are missing here, just to really kind of solidify it. So to me, I think there's 4 basic problems that companies have right here. The overarching one, most companies, I would say, the more complex they get, the reality is that most companies do not have formal capabilities for optimizing value. And it's because they can't plan, manage, and govern outcomes. So they have kind of 4 problems. They still have functional silos, unbalanced targets and resources. The models are inaccurate, and it's slow processes. And I'm going to talk to you about what this matrix management thing means in a bit. But these are 4 capabilities I'm going to talk about. So first thing about functional silos, I just did summarized a bunch of research studies. Reality, it says that functional silos are still a problem. We've known about it for 30 years. It's still a problem. We haven't fixed it. And to fix it, one of the things I'm suggesting is that, first of all, you need to be able to manage productivity. So if you really want to get people looking at something other than a fixed budget, you better give them something that they can manage with, like a cost per order. But you better make sure it reconciles your general ledger and or your budget, because if it doesn't reconcile, chances of somebody believing it and working with it are not too good. So you might have an overall target of $50 an order here, and it may be different by segment. And then you want to be able to manage these trade-offs I've been telling you about. So if you look at this is an order fulfillment process, so these trade-offs may be different by segment. Those process inputs I was telling you about that I just went through in the example, this is really what providing the foundation for this. So the reason why I'm telling you this is that this is, the amount of time that this one individual took to maintain this, it shouldn't be an overwhelming thing. Now, one thing I just want to talk about, a number of years ago, I did a research study for SAP, and where I talked about a lot of this stuff. But I had this research study got into the hands of a very sizable company, and I ended up getting an audience with a good portion of their senior finance function, and these guys were really sharp. I mean, these were probably some of the more thought leading type of FP&A guys you're ever going to run across. Very savvy, S&OP, IBP, operational excellence. And they said, one of the things that we believe, if you look at like this, on the right side, this is a graph of measures for an order fulfillment process. One of the things that they said that, first of all, nobody owns these metrics. So just by virtue of the fact, if we had somebody actually paying attention to this and we could actually measure across functions and legal entities, that would be worth somewhere between, at a minimum, $400 million a year to us to 1.2 billion. That's just a side note for you guys, just to have an understanding of why I think this is really important and why some executives believe that it's important. So the second thing, another thing that companies need to be able to do is manage outcomes. Now, this may seem obvious, but one of the things that managing outcomes entails is not just managing products and customers. It's if you look at outcomes from an entity perspective or a business segment perspective, most companies cannot manage the profitability of their business segments across the entities. And if you don't have outcomes as a structure inside your financial system, the likelihood of you being able to manage it is not so good. So one of the things you want to be able to do is figure out how do your order fulfillment processes and metrics you're talking about, how do they affect customer profitability? And of course, how do your ongoing operations and how are they affected by the projects that you have ongoing? Now, one of the things that drives this from a planning perspective of what I call integrated scenarios, and integrated scenarios is really driven by more sophisticated planning models. So you remember me telling you about the prescriptive analytics software company I work for. One of the things that these things do is they're just a really sophisticated form of activity planning. Now, for those who understand supply chain planning and supply chain optimization, these tools are essentially activity planning on steroids. And one of the things that I'm suggesting is that, the way to effectively manage individual business segments is to utilize these types of tools at an enterprise level. And so, as I mentioned before, this is really driving a mature form of activity planning that drives segment planning. But in a manufacturing world, one of the things that becomes really important to understand is that these sorts of tools are absolutely essential for doing cash flow planning and anything relating to treasury. Because if you don't understand the physical movement of your inventory and the behavior by segment, there's no way you're going to get cash flow forecasting right. And if you look at most big global companies, cash flow forecasting is probably one of the worst processes that they have. And for good reason, because the tools they're using are just far too simplistic. And as well, when these are the sorts of tools that one needs to support what I would call end-to-end scenario planning that can support both finance and operations. So one of the big takeaways here, like if you look at from a finance perspective, one of the things that, as I got into this, because I'm a finance guy who happens to have a pretty deep operational background, this was a big aha moment for me when I looked at these sorts of tools, because I saw how it was that you can drive forward-looking resource-based and activity-based planning models. But the other thing to remember is that if you really want to use prescriptive analytics is really driven by activities and resources, which is, if you look at a lot of the FP&A tools who are driven by charts of accounts, you're not going to see too many of them using prescriptive analytics. This is an enormous hole, I think, in a lot of the FP&A tools right now, because if you don't understand what it takes to run an FP&A, like a prescriptive analytics application, and the need for resource management, you're probably not going to be able to effectively leverage it. And one of the things, if you look at these graphics here, these, the matrix planning, trade-off management, these tools really provide the basis to actually provide this information on a forward-looking basis. And going back to, again, my initial client example, it's these sorts of models that we were talking about that get filled into these nodes and these planning models. And what these planning models do is allow you to manage, connect all these various individual models, and that's the power of it. So the last, I think, really big thing that companies are missing are the ability to support concurrent processes. And to me, it's ability to execute all these processes simultaneously from different perspectives. And one of the things that drives a lot of this is the ability to distribute work and planning models and be able to run simultaneous activities. But underlying all this, if you don't have one single workflow driving this, it becomes really difficult to do. Plus, if you don't have one planning model, that it also gets difficult to do. So these are the things that if you look at most companies, these are 4 things that, and I'm sure that there's others, but these are the 4 main things that I see that most companies are missing. So I'm going to quickly talk to you about how these capabilities fit inside a maturity model. I'm not going to spend a lot of time on this, but what I want to try and do is help paint a picture for you as to how these tools actually drive value. So this is the research study I talked to you about before, and this was the matrix I used inside it. If you look at that research study, this is what you'll find. So what I ended up doing is thinking about that maturity model a little bit differently. So there's really 2 elements to the maturity model: how you're planning, and then how you're managing performance. And this point two here, to me, is really where a lot of companies are really sit right now. They're functionally integrated. They probably tried a lot of these things already. They're experiencing these sorts of things that I told you about earlier. These are some of the problems that they're experiencing. So to get to a level 3, to me, is where you start thinking about and managing cross-functionally. So you're able to, provide these sorts of things on both a forward and backward-looking basis. You now have in your planning models, there's no difference between your financial models and your manufacturing models. They're all the same thing. Your planning activities. Then you start, when you get to the next level, now you're planning outcomes, and you're able to take a target and drive it down through your business to understand what resources you need and how cash is going to behave. And then when you get to level 5, what you're able to do is really leverage these models to utilize prescriptive analytics. So you're embedding that into your model and you're growing into it. And at the same time, you're enabling what I would call dynamic portfolio. So how changes in your business processes are driving the value of various projects and opportunities. Now, the thing is, when you look at this model, it's a tad different than what you find from, like, say, Gartner. Because one of the things that I tend to find is that, even though you have tools in this top level magic quadrant, they're still not enabling you to grab this value. So, that complexity value, which we said was like 3 to 5% of sales, is really not being realized. And I did an assessment of a company who had done this. They picked, these leaders, and the 4 capability gaps I was telling you about before, these things were probably going to cost them $1 to $2 billion over the next 5 years. And they were just major capability gaps that they were having that they weren't going to be able to fix. And it's really this inability to manage outcomes and inability to manage these trade-offs, which is the problem. And this is sort of a little graphic, I put in just for fun, but, to me, I think a lot of the things I'm seeing in a lot of these tools are really, to me, are really kind of cosmetic. They're not really addressing a lot of the underlying problems. Because if you look at, these unwritten rules I talked to you about before, the functional silos, the 2 major things that, if you look at most research studies, tell you that are undermining strategy are functional silos and culture. And if you don't understand that, I think that you're really you're not going to get what you're looking for. And one of the challenges I see a lot of things out there, like I see all these buzzwords like integrated FP&A, extended planning analysis. To me, I don't think the world needs more better buzzwords. I think these things are terribly ill-defined, and I'm not sure if they're really kind of addressing the issues that companies have in kind of bigger companies.
Okay, Dean, sorry to interrupt
yes.
you, but we have only 15 minutes left. So if we should have some time for questions in the end, maybe we should wrap up in the next 5 minutes or so.
I'm going to get through pretty quick because I do want to have time for Greg. So I'm going to collapse the next, rather than spending 10, I'm going to spend a few minutes on it. Okay.
Good.
Right. So let me just quickly tell you about how I see these processes fitting together. I'm not going to spend a lot of time on it, but if you look at integrated planning, you'll see that being described as a 5-step process, and here they are down here. I think they're missing a couple steps which get translated into this process. To me, so what this is, it represents rolling forecast, sales and operations planning. And to me, it's all one process. It's connecting inputs and outputs. That's, of course, what I call dynamic cost and profit optimization. And what I'm going to show you here, that the main thing that really kind of glues all this together are the things I was telling you about before, like with this, the case study I showed you. This is it right here. So if you recall how little time that they spent on this, when you think about it at a functional level, This is sort of the thing that glues it all together, and the ability to manage both from a functional perspective and a process perspective. But again, the main thing I want to get across here is that the things I've showed you before all fit into this process, and I'm not going to go into it all right now. But one of the major things that I think is in major changes is the ability to manage the introduction of kind of new products and customers, have a process and use the same model that you use for planning in finance and operations to understand how all these things affect the business. Now, one of the points I want to make get across here is this is not theory. So I've actually done some work with a company to you. If you've never heard of low-code application development programs, we've actually done this. We've actually got a what do you want to call it, a prototype that takes a few different what I would call best of breed models, puts them together, supports this process, and supports the type of value proposition I was telling you about. We can do something at a later date if you're interested in getting into more detail about it. The main point I want to get here is this is not theory. The technology exists to do it, and I've looked at it, and there's some these processes support what I would call a more sophisticated approach to data-driven processes, one of which I also have a video that describes all this, but a lot of things like, for example, doing automated variance analysis where you identify volume, mix, price variances. And to me, one of the other things is automated models. Like if you're manually developing and maintaining financial planning models, to me, that's a thing of the past. The reality is that if you look at, where I think things are going, there are just massive redundancies between S&OP and IVP. I think, if you look at, one of the reasons why I think that Morton is doing this is that he and I both see that there's massive things that are going to get eliminated in finance through automation. And you can see some of these on here, but I think that Greg will probably comment on this a little bit as well. But one of the things I'm not saying as well is you don't necessarily have to throw away what you got. I think there's tools out there and approaches you can use to augment what you have. So just a quick note about the finance strategy. Just going back to this idea that I don't think there's one fully integrated process, but hopefully you saw what I was saying here is that you can see how you can reduce cycle time, reduce the cost of planning, and why it's going to drive the type of value I was telling you about by managing value and complexity. So these are kind of three things that I think that most companies still struggle to address. One of which is kind of self-adjusting cost structures, and then taking your strategy and driving it into projections of free cash flow. If you look at any company who's invested all these different in the rolling forecast, sales and operations planning, balanced scorecard, they still can't do these things. So these are the things I think that this process supports. Now, some of the things that I think that finance guys really need to understand are some of the things I have on here, but one of which is the understanding of operations, and especially things like prescriptive analytics and flow-based driver models. Those are some of the things I think you really need to understand, as well as how I believe management systems are going to evolve. You can call it integrated planning and performance management or management systems. There really is no word to describe this, but I believe that the next evolution that supports these kind of higher level processes are this. And the thing I want to point out here, see, integrated reporting, integrated thinking. Anybody, especially people in Europe, finance people, if you know what's going on up there in terms of integrated reporting, this is a really big deal. And I think what I just described here is very consistent with what the people from the integrated reporting function are really talking about. And in order to get there, I think that one of the things that people need to understand at the very beginning is that when you go to buy or implement financial systems or integrated planning systems or supply chain planning systems, the first thing that you need to do is step back and look at it from a more holistic perspective. And the reality, I think that most companies are not doing that. So there's this education, especially with the executive team, that you need to help them understand why it is that, or what it is that you need to drive a truly integrated system. And one of the things I just put this in as an aside, is there's probably going to be some pushback, because reality is that, you know, the traditional tools are not doing this. So you're probably going to be looking at some sort of best of breed approach. So there's going to be some perceived risk. So you're going to have to balance, like, what's the risk versus what's the value, because I think the value is pretty significant. So I'm just going to just stop there for a sec, and I'm going to hand this over to Greg, let him to provide some commentary on this, and then you can kind of fire some questions at me and or Greg, or I'll leave it there.
I'll just be really quick. I know you have some questions to ask. So just if I could take away or let you guys in on one thing that I've learned as a CFO for a few companies, food industry in the United States, is that you will have more success allowing operations to own their models. And by getting closer to operations and being a partner with them, you'll be able to take the business further than if you were to control the model and own the model yourself. Now, as finance people, we definitely have to control the model to an extent, and then base all of our forecasts off of that model. But the more accurate your operational model is, the more accurate your financial model becomes. So I know that we don't have much time. That's what I'll leave it at. But thank you guys for listening today.
So those are some of the questions that we said they were going to address. Hopefully we addressed them. Maybe I'll just leave it there, and if you want to open it up for questions, Morgan. Sorry, we
yeah, no problem, Dean, and thank you very much for the presentation, and thank you, Greg, for chipping in with your perspective. We have a question from the audience in the chat. It's from Steve Nevin. It's an interesting question. Steve asks, when it comes to resources or input, is it also necessary to assess their quality? I mean, that I guess it's the point that not all input are the same. So not all people are equal in their knowledge, for instance, their capabilities, and so on. So how do you get deeper, or sort of a more nuanced perspective on the input in these models?
Yeah, it depends on which model that you're talking about too. But you know, I think one of the things that you have that I always find is that when you develop a model, one of the things I'm always trying to do is think of the person who's running the function. How do I help them articulate how many resources that they need? So, and you have to get in some cases, you have to get into a fair amount of detail. I can show you one that I did for like a warehouse, and not just a warehouse, but you know, this was like a series of warehouses, and you really had to think about like and segment the business. Like you have, this was like a food and packaged goods company where you had, you know, big chain stores versus smaller stores, how that impacted, you know, cost per pick in the warehouse. You know, it was a fairly elaborate model, but you know, a big part of it is helping, you know, when the process of developing these models, I think, is, you know, getting people all on the same page as to how service levels, you know, quality levels, you know, quality targets impact resource consumption. And when you get to that point where people can say, oh yeah, you know, that really represents my view as to how many people that we actually need, given what you're asking me to do. To me, that's where you get to the point now where now you got a model where you can start having these dialogues around, you know, how much, you know, what service levels we want to provide, what quality levels can we afford to give, that kind of thing. I'm not sure if that answered your question, but to me, that's part of the process, if you will.
I know. I mean, we can thank you for the question, Steve. Steve, if you want to add anything, you can take the mic now, or if you just want to follow up.
I think it did. Thanks, Dean. Yeah, because it kind of goes back to what you said with the earlier example, like the review in the book.
Yeah,
The academic book producer. Yeah, essentially how you described it was that their Q&A process was broken, and therefore they were undermining the quality of their product and effectively cannibalizing it internally. So yeah,
right.
it kind of goes to, I think how you described kind of goes also to what Greg said. So if you get the operational people in the loop, they'll call out what the main pain points are, the main drivers of their performance moving either favorably or adversely, and try and factor that in as much as you have some reliable measures into whatever you model.
Yeah. So I'll bet, one of the things in talking to Greg, one of the things that you were telling me that your experience with sales and operations planning processes and how you're trying to balance resources and all that really kind of helped in your evolution of your understanding, as it did mine.
Yeah, that's right. As you really try to implement the sales and operations planning, you start looking at these things weekly and daily, but weekly with the operations partners and your demand planning group and your supply planning group and also the sales group. So as you really partner, like I said before, the stress for me has been on partnering with the operations groups and letting them own it. And then really, as that happens, the fluff goes away. They understand their business better. They know how to pull those levers that will actually drive the business. And then what we see is the financial results follow. So a great cycle, though, if you're looking weekly and doing an S&OP process.
One other thing, I'll just from a tactical perspective, Greg, perhaps you could just comment on it. I believe that, just by, working with ops and leveraging their model, I think a lot of the work within finance goes away. Wouldn't you agree?
That's right. I've been in charge of FP&A groups in finance, and a lot of the work is redundant between an FP&A group and the operations planning group. Really, if you join forces and take away some of that redundancy, I think it's sad to say on the finance side, we likely don't need as many people in FP&A if you get this S&OP process working right. But in my opinion, the future of accounting is every accountant is an analyst. So it makes our jobs, I think, all the more important for all of us to be higher trained and more technical, and also just better business people, because there will likely be less of us, in my opinion. But
thanks, Greg and Dean. I think we have one more comment in the chat. Maybe we have time for one more question. It's Eric, who congratulates you on a good presentation. And also, I mean, Eric, you have several questions. Do you want to ask one of them here as the final question for today? Or do you want to prefer to do it offline?
Oh, no, I'll ask really quick. I have so many of them. Boy, I guess the biggest one would just be, I'd just like to hear your guys' thoughts on, how do we even start this process and sort of sell it to operations, sales, whatever key business functions, just to get them on board that we kind of need this process. And I know that's a huge question and sort of loaded.
can I quick stab at it, Dean?
Sure, absolutely.
So what I found is if you can show them a rough model of why it's important, that really helps a lot. I've struggled sometimes getting the sales group to give a detailed look at their sales forecast, but that's really the starting point for most of these models, is what are they going to sell, which leads into what are we going to build. And so if you can show the sales group that you need their SKU forecast by customer, by period, and then show how that rolls into the planning or the operations planning forecast, I think they see it pretty quickly that they need to do it, and they need to do a better job of giving you the detail. That's my experience. It's been at 3 different companies. We've implemented this, and people have gotten on board very quickly after seeing how they fit into the whole model.
Yeah, one other thing I just build on that, like, to me, ultimately, any change in the business, you got to answer one question: what's in it for me? Like, why should I spend all this time with, to develop some new capability. What's gonna happen for me? So in the case of that the case study I presented, the what's in it for me was I now only have to spend 2 or 3 days on budgeting. I'm not going to be stressed out because, you know, you're asking me to do things I can't do. So the whole expectation management thing, just from an individual department manager, is a huge selling point. But just from a strategic perspective, when you talk to finance, you know, the CEO, I mean, of course, you know, driving strategy and all that stuff. But I think just practically speaking, you know, depending on the size and complexity of your company, the reality is that I would say, I'll just give you some ballpark numbers. But if you're, say, like if I were like a $2 billion manufacturing company, and, you know, they had all the complexity characteristics, you know, lots of products, lots of customers, lots of variation, blah, 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 and you had functionally driven processes, you're going to be hard pressed not to pull out $20 to $50 million. I mean, I can tell you that right now, as somebody who's done piles of cost reduction work, you know, if you're not thinking about this as a self-funding thing, you're missing the opportunity here. Not to mention the fact you can probably like one other thing within FP&A, like anybody who's on the phone in FP&A knows how hard it is to find good FP&A folks these days. They're just, you know, they're just hard to find. So if you can, you know, reduce the amount of people that you need in your staff, that's going to be a huge selling point, especially if you're, you know, improving the quality of the process.
Okay, I think we are out of time. I'm terribly sorry to break off this interesting discussion here, but I think we have to say thank you very much to Dean and to Greg, and to some great questions from the audience. Thank you for participating in this webinar, and yeah, have a nice day, a nice evening.
Cheers.